Howdy, Jacob here. Today we're looking at the Hackett Group. The Hackett Group is in IT services, pretty small company, 700 million enterprise value on 688 million market cap. Founded in 1991, so it has been around for a little bit, but it is pretty small. Let's see if insider ownership is pretty big. 10% held by insiders, very solid. So for smaller companies, it's definitely more advantageous to see a higher insider ownership, representing hopefully better decisions made by management that are in line with the shareholder. And we see that they operate as a consulting firm pretty much globally around US, Europe, internationally. Revenue growth is not crazy impressive, 237 million to 297 over a 9-year period, but margins are expanding pretty heavily, which is awesome. Return on invested capital is beautiful the last 3 years, high 20s. You gotta like that. Balance sheet, 21 million cash on hand with just 33 million long-term debt. Beautiful balance sheet, very safe. And then cash flow, yeah, very low capital expenditures compared to their cash from operations. Absolutely love that. Use of cash is a little bit on the acquisition side. In the last 10 years, though, it's probably less than 5%. And then when it comes to, big use of cash flow, looks like debt pay down is probably around 10%. Dividend is paying out about 25%, and then stock-based or stock repurchases. It looks like they change how much they pay for stocks depending on when it's cheap, based on them buying 2 million, 12 million in aggregate, and then 116 million. So maybe they're thinking in 2022 their stock was super cheap. Hopefully that was the case. Or else sometimes companies just buy when they have a lot of money, and that's not advantageous to you as the invest, or that's not the most advantageous way to use those dollars. And but here, I mean, I'll have to look more into that if I did a deeper dive to see when they're what type of shares they're buying. Are they cheap? Are they, fine, whatever. But use of cash, I mean, it looks fine. It looks like paying out a dividend of 25% of their free cash flow is really not doing much to them. Their debt isn't very concerning, so that's not really a concern. And then it's really just um, repurchasing shares. As a consulting company, yeah, I could see how when you reinvest, your capital expenditures don't go up that much more. But with those rates of return, you definitely would want to see this company, if they can, reinvest in their employees through higher salaries to further incentivize extra payments, since they really don't have to invest much to get a solid return on their money. They do have 11 million stock-based compensation, so that is about 25% of their free cash flow, 25 to 30% of free cash flow. So um, that'll show up in the share issuance. So let's start making some assumptions here. I don't think there's going to be a lot of growth here based on what we're seeing here, but I could easily see 3% a year with a 15 PE. Margins have been going up pretty substantially. Free cash flow is higher. So let's maybe do maybe 10 and 12. And then let's do 0% share change, to where maybe they buy a good amount, but that stock-based compensation is, they do issue a lot of shares through stock-based compensation. And so if we look at their dividend, with it only being 25%, I might just increase it with their revenue increases. And then we get to a price that needs to fall 60% before you get a 15% return with these assumptions. I just don't think the company's growing enough for it to have the valuation it does. To me, I think that these are reasonable assumptions. And although the company does look like a good company, I'm just going to have to wait to do a deeper dive on it until it gets to a price that is more attractive to me. So thank you, and have a great rest of your day.